Trump's tariffs are not a prediction. They're a calculation. According to the Peterson Institute for International Economics, the current tariff regime will cost the average American household $1,500 in 2026.
And that's not a maybe. It's already baked into the math of the trade barriers that have been put up.
And I think it's important to stress that the $1,500 figure,
Yeah.
it's just the average. It really masks the damage at the top end.
It does. If we zoom in on the specific demographic in this briefing, the macro-minded wealth builder, we're talking about the top income quintile. For them, the cost is nearly double.
So what's the number?
It's a $2,800 hit to their disposable income this year.
Okay, so why the big disparity? Why does the wealthier group take a bigger hit in absolute dollar terms?
Well, it really just comes down to consumption patterns. It's about what's actually in their shopping cart.
More imported goods.
Significantly more. That demographic consumes far more imported electronics, luxury goods, European automobiles, all the high value added goods that this tariff regime specifically targets.
So if you're buying a washing machine, you pay a tax. But if you're buying a high-end German sedan...
Or the latest flagship smartphone, yeah. You're paying a much, much larger tax. The bill is absolutely coming due.
Looking at the broader economic picture, the scale of this shift is...
Yeah.
It feels just unprecedented. We're looking at data showing that between January of 2025 and right now, January 2026, the average effective tariff rate in the U.S. jumped from 10% to 23%.
And to put that number in perspective, that is the largest single-year increase in U.S. trade barriers since 1993.
The largest in over 30 years.
By far. And if you look at it in macroeconomic terms, as a percentage of GDP, this is a 0.47% tax increase. That is the single biggest tax hike in 3 decades. It's bigger than the Clinton tax hikes, bigger than the fiscal cliff negotiations.
It's a massive withdrawal of liquidity from the consumer.
From the entire economy.
But here's the part that I think is confusing people, and maybe it's why there's this sense of complacency right now. It's January 18th, 2026. If I walk into a store or I look at the consumer price index, inflation hasn't spiked. Not yet. We're not seeing some crazy 10% print. Why is that?
There's a term for this that Goldman Sachs has been using. They call it delayed detonation.
Delayed detonation. What does that actually mean in practice?
Think about how a supply chain really works. It's not real time. The TV you might buy today wasn't imported yesterday. It was likely brought in 3, maybe 4 months ago.
So we're in this weird temporary window.
A very specific, very temporary window. Right now, companies are just eating the margins. They're drawing down the massive stockpiles they furiously built up in late 2025 when all the tariff announcements were being made.
So everyone just front-loaded their orders, they panic bought.
Panic bought is exactly the right term. We saw warehouse capacity hit 99% in December. So retailers right now are selling inventory they bought at the old price.
Trying to keep prices stable, hold on to market share.
Hoping this all blows over. But that inventory is finite. It's going to run out. Their supply contracts are going to expire.
And when that warehouse is empty.
That's the detonation. The Congressional Budget Office is estimating that the full inflationary impact is going to hit between the second and fourth quarters of this year.
So we're essentially in the eye of the storm.
The termite analogy from the briefing is perfect here. You don't see the damage until the termites have already eaten through the foundation. The structural damage to the price mechanism is locked in, even if the price tag on the shelf hasn't changed yet.
This all feels like completely uncharted waters. I mean, have we ever actually tried to run an economy this way before?
We have. And the briefing is very, very explicit about the historical parallel we should be looking at.
Which is?
We were reliving June 17th, 1930.
Smoot-Hawley.
The day President Herbert Hoover signed the Smoot-Hawley Tariff Act into law, we are watching the exact same script. It's just playing out at 100 times the speed.
I think most people remember Smoot-Hawley as just a bad thing from history class. But can you break down the actual architecture of that disaster? How does it really compare to what we're seeing right now?
The parallels are genuinely disturbing. I mean, back in 1930, the average tariff rate went from about 40% to 48%.
So 20% relative increase.
Right. It was bad, for sure, but it was almost incremental today. We've gone from 10% to 23%. That's a 130% relative increase.
So the shock to the system, in relative terms, is actually much worse now.
The shock is significantly more severe today than it was during the Great Depression. The global economic system is just less accustomed to this kind of friction. And what's really striking is that the origin story is almost identical.
How so?
Smoot-Hawley didn't start as some massive global trade war. It started as a pretty modest bill meant to help farmers.
And then the lobbyists got involved.
It was a political feeding frenzy. Once that bill hit the floor of Congress, every special interest wanted their cut. You had brick makers wanting protection, lace makers, glass blowers. It just ballooned.
Covered something like 20,000 goods in the end.
Exactly. And just like today, the overwhelming economic consensus was completely ignored.
There was that famous petition, right, from the economists.
In May of 1930, an economist named Paul Douglas organized it. Over 1,000 economists, 1,028 to be exact, signed an open letter. These were the smartest minds in the world. They literally begged Hoover to veto it.
And their warnings were?
The exact same things we're hearing now. They warned of higher prices for consumers, they warned of immediate retaliation from other countries, and they warned it would destroy American exports.
And Hoover just ignored them.
He signed it for his own political survival. He thought it would save his presidency. Instead, it deepened the Depression into what we remember it as. And the retaliation, that was the kill shot.
That's always the other side of the coin, isn't it? We slap a tariff on them, they slap one right back on us.
In 1930, Canada was our largest trading partner, just as they're a massive partner now. They responded with what was called the Dunning tariff.
And the effect?
U.S. exports to Canada collapsed by 79%. Globally, 25 other countries retaliated. Global trade fell by 66%. But here is the critical difference between 1930 and 2026.
The speed.
The velocity, it's everything. In 1930, retaliation took months. News had to travel, parliaments had to debate, laws had to be passed. Now, retaliation takes hours.
Literally hours.
When the steel and aluminum tariffs were announced in February of 2025, China announced their counter tariffs on the same day. The EU filed WTO complaints within 48 hours. As we sit here today, 34 countries have imposed retaliatory tariffs in just the last 12 months.
The termites aren't just eating the foundation, they're swarming. So let's walk through how we actually got here over this past year. It didn't happen all at once. The briefing breaks it down into 3 distinct phases.
It was a gradual but very deliberate escalation. Phase 1 was February 2025. That was the reimposition of the Section 232 tariffs.
This is the national security justification.
Right. The argument is that we need domestic metals for our tanks and planes. So 25% on steel, 10% on aluminum. But the key is that this didn't just target our adversaries, it targeted our closest allies.
And the response was, as the briefing puts it, surgical. How so?
Canada, for example, didn't just tax random American goods. They looked at the U.S. political map and struck back dollar for dollar on the most politically sensitive goods imaginable.
Aiming for maximum political pain.
Maximum pain. They put tariffs on dairy to hurt farmers in Wisconsin. They put tariffs on bourbon to hurt distillers in Kentucky. They were aiming directly at the political pain points of the administration's leadership.
Trying to make voters in those key swing states feel it directly. Then came Phase 2 in April, the China escalation.
This is where tariffs on most Chinese imports jumped to 45%. But China's response? This wasn't just a simple tit-for-tat tax. This is where the modern trade war really differs from 1930. China weaponized the supply chain itself.
What does that mean, to weaponize the supply chain?
They didn't just tax goods coming in, they banned the export of critical materials going out, specifically gallium and germanium.
I'm guessing those aren't household names for most people listening.
They shouldn't be, but they are in everything. They are absolutely critical materials for high-end semiconductors and advanced defense systems, radar, missiles, satellites.
It was an asymmetric response.
A profoundly asymmetric response. The message was, you tax our washing machines, we cut off the raw materials for your missiles, and on top of that, they devalued the yuan by 8%.
Which partially offsets the tariff, right?
Again.
It makes their goods cheaper in dollar terms.
Exactly. So they effectively launched a currency war alongside the trade war. It's just a race to the bottom.
And then Phase 3, the hammer drop in October 2025.
The universal baseline tariff, a 10% tariff on all imports from all countries. Friend, foe, it doesn't matter anymore. Everything gets hit.
And the stated purpose of that was to raise revenue.
The projection was that it would raise about $300 billion, which would then be used to fund domestic tax cuts.
But the inflation projection that came with it.
Somewhere between 1.2 and 2.1%. And you have to remember, throughout all of this, we have no referee. The WTO's appellate body has been non-functional since 2019. There is no one to stop this. It's a global free-for-all.
Okay, I want to pivot to the mechanics of this. how does this actually hit our listeners' wallet? You mentioned earlier that the real pain starts in Q2. Why the delay? Why Q2 specifically?
It all comes down to something called the absorption limit. When an importer gets hit with a tax like this, they really only have three choices. Choice one, absorb it. You just eat the cost, take a hit to your profit margin to keep the price stable for your customer. Choice two, pass it through, you raise the price. And choice three, you try to switch suppliers to a country that isn't being tariffed.
And we are currently in choice one, the absorption phase.
Deep in the absorption phase. Companies are terrified of losing market share. If Samsung raises the price of its TVs and Sony doesn't, Samsung loses. So for now, they're all accepting lower margins. But you can't do that forever. Profit margins are already razor thin in most of these industries.
Eventually, the math just stops working.
And that's the phase we're entering now. The Yale Budget Lab put out a study in December that breaks this down. We are entering the pass-through phase. And this study shows that this tax is incredibly regressive.
Meaning it hurts the poor more than the rich.
In percentage terms, yes, absolutely. For the lowest income earners, the cost is about $800 a year. Now, that might sound manageable, but that's 2.7% of their total income.
A massive hit to liquidity for a working class family.
A huge hit. But for the top earners, the cost is that $2,800 figure we talked about.
Which is much higher in absolute dollars, but a smaller percentage of their income.
Exactly. It's only about 1.4% of their income. But the reason they pay more in absolute terms is simply their consumption. High-income households are the ones buying the stuff that's being targeted most heavily.
Let's get really specific on the price hikes. What should people be preparing to see starting next quarter? The briefing highlights electronics first.
Electronics are going to be the hardest hit sector. We're looking at an 18% jump on average. This is your laptops, your smartphones, your tablets. Apple has already quietly signaled that iPhone prices are rising by about $120 in Q2.
That's a very significant jump for a phone.
Then you've got automobiles, up around 12%. People tend to forget that a car isn't just made in America or made in Mexico. A car crosses the border roughly 6 times during production.
So it gets hit with a tariff at each stage.
The engine block is cast in Canada, it's machined in Michigan, it's assembled into the car in Mexico, the finished car is sent back to Ohio. Every time it crosses the border, ding, another tariff. The average car price is projected to hit $54,000.
Wow. What about something like clothes?
Apparel is up 9%, and this is going to hit the fast fashion sector, your Zara's, your H&M's the hardest. They operate on such razor-thin margins they can't absorb anything. They will pass that 9% cost on to the consumer immediately.
Heavy food.
A little lower, around 6%, but it targets very specific things we simply can't grow here at scale. Coffee, bananas, seafood. You can't just switch to American coffee. It doesn't exist.
So is there any safe harbor in this? Is anything safe from this kind of inflation?
Energy, really. The U.S. is a net exporter of energy, so unless we see some major geopolitical shock, energy prices are the one thing that should stay relatively stable through this. But for almost everything else you buy, the pass-through is coming.
Now, the media, they usually focus on the price of a toaster or a car, the visible pain. But the briefing argues that the real economic destruction isn't from the rising cost of imports, but from what it calls the export apocalypse.
This is the hidden damage. It's the other side of the ledger that no one talks about. The U.S. exports $2.5 trillion worth of goods and services a year. When we put up walls, other countries put up walls. And the biggest loser here, the absolute number one casualty, is American agriculture.
We saw a preview of this with soybeans a few years ago.
And it's happening all over again, but on a much larger scale. China went from buying 60% of all U.S. soy back in 2017 to almost nothing. And they didn't just stop eating soy, they diversified. They went to Brazil.
Permanently.
We watched U.S. soy exports to China crash from 31 million metric tons to just 4 million.
Can't we just find another buyer? Sell it somewhere else?
You can't just find a new China. That market didn't just pause, it vanished. It was replaced. Soybean prices fell from $13 a bushel to $9.50. For many farmers, that is below the cost of production.
And it's not just soy.
No. Pork and wheat markets in Mexico and Europe have been closed off by retaliation. The damage is across the board.
I recall the government provided a bailout previously. The USDA put up, $12 billion?
Which the briefing correctly calls a Band-Aid on a severed artery. Farmers need markets, not subsidies. You can pay a farmer to survive one bad year, but you can't pay them enough to replace a customer that has left forever. Once Brazil builds out that port infrastructure and locks in those contracts, that trade route shifts permanently.
And this all bleeds into what the briefing calls the manufacturing paradox. The entire political justification for these tariffs was to bring jobs back. The slogan was, "Make America build again."
And yet, the hard data shows that manufacturing jobs in the U.S. actually fell by 100,000 between January 2025 and January 2026. The policy achieved the exact opposite of its stated goal.
How is that even possible? If foreign goods are more expensive, shouldn't we be hiring people to make them here instead?
Because that's not how modern manufacturing works. It's incredibly capital intensive and completely dependent on global supply chains. You cannot reshore the entire supply chain for a Ford F-150 in a year. It takes a decade, maybe more.
So in the meantime, Ford just has to pay more for its inputs.
They have to pay more for steel, more for aluminum, more for thousands of components. Their costs go up.
Which makes them less competitive.
Exactly. And at the same time, they face retaliation when they try to sell their finished cars abroad. So they sell fewer cars, they make less money, and eventually they have to lay people off.
This brings up an economic concept in the briefing called the Lerner Symmetry Theorem. It sounds complicated, but it seems absolutely crucial to understanding why this always backfires.
It sounds like academic jargon, but it's actually a very simple and very powerful concept. Lerner symmetry proves mathematically that a tax on imports is equivalent to a tax on exports.
Okay, break that down for us. How does taxing a German car hurt an American soybean farmer?
It all comes down to the currency. Think about it. When you block imports, say you stop buying German cars, you are sending fewer US dollars abroad.
Okay.
So there is less demand for foreign currency, like the euro, and there is a smaller supply of dollars available globally.
So the dollar becomes more scarce relative to other currency.
The dollar gets stronger, and if the dollar gets stronger, it becomes more expensive for foreigners to buy American goods. If you're a buyer in Brazil and the dollar suddenly spikes, American corn looks incredibly expensive compared to Argentine corn, so you stop buying American.
So by trying to protect one industry, like steel,
you inadvertently crush export-driven industries like agriculture and aerospace. The seesaw always balances. You cannot protect one side without punishing the other. It's an economic law.
So understanding that the macro environment is, well, it's hostile. Let's pivot to what our listener actually does about it, the investment playbook. The briefing is very specific here. It says the strategy isn't to leave the market, but to understand what it calls asymmetric pain.
Right. You can't just go to cash and hide, because inflation is just going to eat your cash alive. The key is to separate your portfolio into two buckets: avoid and favor.
So what's on the avoid list?
The avoid list is anything with heavy export dependency or complex, fragile global supply chains.
Let's name some names. What are we avoiding?
Agricultural equipment is number one. Look at a company like Deere.
Because of the farmers.
It's that simple. Farmers with no income and no future market don't buy new tractors. Deere is a direct proxy for the health of the American farmer. If they're bleeding, Deere is bleeding. The stock is already down 18%.
What else is on the list?
Semiconductors. Specifically, companies like Intel. Those gallium and germanium export bans from China are choking the supply chain. You can't make advanced chips without the raw materials, and if you can't get the materials, you can't ship the product. It's just too risky.
And I'm assuming the big automakers are on that list too.
Ford and GM are in the kill zone. They're getting hit from both sides. They have margin compression from the steel tariffs. Their raw materials cost more, and they have export blockades closing off their foreign markets. Ford's stock is down 22%. It is not the time to be a hero in the auto sector.
So that's what to avoid. Where do we hide? What's on the favor list?
You favor the domestic and the inelastic. Utilities are the absolute standout here. Companies like NextEra or Duke Energy.
Why utilities?
Because you can't export a power grid.
Yeah.
They're almost completely immune to trade wars. They produce energy here, they sell it here. It's a closed loop. If you look at the 1930s, utilities outperformed the S&P by 40 points. It's the ultimate defensive play.
And domestic staples. What falls under that?
Think Coke, Procter & Gamble. Companies with real pricing power. If the cost of an aluminum can goes up, Coca-Cola just raises the price of the soda by a few cents. People keep buying. They have the brand loyalty to pass those costs on without losing significant volume.
The briefing also adds defense and healthcare to that list.
Because demand there is inelastic. People don't stop getting sick just because tariffs are up. And governments don't stop buying missiles. In fact, they often buy more when trade wars increase geopolitical tension. It's no accident that Lockheed stock is up 14%.
There's also a big section on the gold hedge. Is this just the standard buy gold when you're scared advice?
It's a bit more technical than that. Gold thrives on two specific things: inflation uncertainty and currency instability. We have both in spades right now.
The price has already broken $2,400 an ounce.
It has. But you have to look at who is buying. It's not just individuals, it's central banks. China and Russia are accumulating physical gold at record speeds. They're actively trying to de-dollarize their reserves.
Moving away from the US dollar system.
And gold is the primary alternative. The historical precedent is stunning. In the 1930s, the Homestake Mining Company rose 470%, while the Dow fell 89%. Gold is the insurance policy against this kind of policy failure.
The briefing also mentions a bond paradox, which seems a little counterintuitive.
This is the trickiest part of the playbook, and it's all about timing. You have to understand the yield curve. Short-term treasuries are safe. You can park cash there. But long-term treasuries, the 10-year, the 30-year, are extremely dangerous right now.
Because of the inflation risk.
Correct. If inflation is running hot, the fixed interest payments you get from a long-term bond become worth less and less. So the price of the bond itself falls. However, and this is the key, they will be the play later.
When is later?
When the inevitable recession hits. When the economy finally breaks under the weight of these tariffs, the Fed will be forced to slash interest rates to try to save the system.
And when rates get cut, long-term bond prices rally.
They rally hard, but you have to time that pivot perfectly. You don't buy them yet, you wait for the crack.
Let's zoom out to the why. Why do politicians do this if the economic data from 1930 all the way to the present is so clearly and consistently negative? The briefing points to something called public choice theory.
It really boils down to the difference between concentrated benefits and diffuse costs. This is the core of all political economy.
Can you give us the classic example?
Sure. If I, as a politician, put a huge tariff on imported steel, a steel worker in Ohio keeps his job. That is a very concentrated benefit. He knows exactly who saved him. He will vote for me. He'll donate to my campaign. He'll tell his friends.
And the cost of that tariff?
The cost is that every car, every toaster, every construction project in the entire country gets a little bit more expensive. Maybe it costs every single consumer $50 a year. But here's the trick. Nobody votes against a candidate because of a $50 hidden cost. It's too diffuse. You don't even notice it.
So the benefit is very loud, and the cost is completely silent.
Precisely. And then you get what's called the ratchet effect. Once those tariffs are up, the industries that are protected, the steel mills, the unions, they form incredibly powerful lobbies to keep them. They become addicted to the protection.
So it's a trap.
It's a one-way door. It is very easy to put tariffs on. It is politically suicidal to take them off.
So if that's the case, how does this end? If inflation spikes, if the market really starts to wobble, what are the exit routes for the administration?
He really only has three options. Option one, the most likely, is he just declares victory. He negotiates some cosmetic deal with China or the EU that basically just restores the status quo. Maybe they agree to buy a few more soybeans, and he claims he won the greatest trade deal in history.
That seems like the path of least resistance.
It is. Option two is to blame the Fed. If inflation spikes or a recession hits, he can just claim that interest rates were too high, that Chairman Powell sabotaged the beautiful economy, and that the tariffs were perfect, but the central bank failed the country.
And option three, the one that actually fixes it.
An emergency reversal. But this only happens if the pain becomes so great that it's politically unbearable. We're talking about unemployment breaching 6% or a 30% stock market crash. Only that level of pain forces a genuine reversal.
We also need to touch on the second-order effects, the things that aren't on the sticker price, but that fundamentally change the structure of the economy.
Reshoring is the big buzzword. Everyone talks about moving supply chains out of China, and you see it happening. Apple is moving production to India and Vietnam. Strategically, it sounds good.
But practically, what's the result?
The result, in Apple's case, has been lower quality control and lower profit margins. Their gross margins have dropped from 43% to 39%. You're trading efficiency for security. That cost is permanent. We're moving from a just-in-time economy to a just-in-case economy, and that is inherently more expensive and less efficient.
And deeper than that, there's the issue of de-dollarization.
Trade wars massively accelerate the move away from the dollar as the world's reserve currency. If you weaponize the financial system, if you use the dollar to enforce tariffs and sanctions, people will eventually stop using your system.
And we're seeing that with the BRICS nations.
They are actively building parallel systems to trade in their own local currencies. It's not an overnight collapse of the dollar, but it's a slow, steady erosion of American financial power. It's a leak that's getting bigger.
Plus the innovation slowdown.
Protectionism just makes companies lazy. The classic example is the British steel industry in the 20th century. They got tariffs, they were protected from German competition. And what did they do? Did they invest in new technology? No. They paid out dividends and stopped innovating. They eventually became uncompetitive and died. Competition is painful, but it's what drives progress. Tariffs act as a powerful sedative.
Okay, finally, let's look at what the briefing calls the asymmetric opportunity, the wealth builder's horizon. It suggests that this pattern is actually very predictable.
It is a predictable cycle. Tariffs escalate, the economy contracts, assets become distressed, the tariffs are eventually reversed, and then those assets recover spectacularly.
So the real money isn't made by avoiding the loss right now.
No, it's made by buying the bottom later. The briefing projects the prime buy signal to appear somewhere between 2027 and 2028.
And you have to have the stomach to wait for what it calls maximum pessimism.
You have to wait until it feels like the world is ending, when everyone else is panicking. That's your signal.
What are the specific indicators? How do we know we're actually there?
You look for hard data. Farm bankruptcy rates exceeding 10%, manufacturing unemployment climbing over 8%. And you look for genuine political panic, when the politicians stop bragging about the tariffs and start panicking about the deficit and unemployment. That's the bottom.
And what's on the shopping list when we hit that point of maximum pain?
You buy the things that were destroyed on the way round. You buy Deere when it's trading at 8 times earnings. You buy Ford or GM at what look like bankruptcy prices, maybe $5 a share. You buy up Midwest farmland at a 30 to 40% discount from sellers who are forced to liquidate.
This is the Joseph Kennedy strategy from the 1930s.
Kennedy famously went to cash before the 1929 crash. Everyone thought he was crazy. Then he came back in the early 30s and bought distressed assets for pennies on the dollar. John Templeton did the same thing in 39, buying stocks under $1. Howard Buffett bought farmland during the Dust Bowl. It's the same play.
So the tariff regime is, in essence, a machine.
It's a machine that destroys wealth for the unprepared, but it creates generational entry points for the patient investor. It moves wealth from consumers to protected industries, and eventually it moves all of that wealth from the reactive victims of the crash to the strategic buyers of the wreckage.
The timeline seems clear. Phase 1 is safety and gold. That's right now. Phase 2 is building a cash position. That's mid-2026. And Phase 3 is aggressive buying, starting sometime in 2027 or 2028.
That's the playbook.
So the provocative thought to leave you with is this. The question isn't whether this policy will fail. History guarantees that it will. The question is, when the reversal comes and the fire sale begins, will you be the victim of the crash, or will you be the one buying the wreckage?
That's the only question that really matters.
We'll be watching the numbers.